Hi friends, this is Sri Devi. I'm a registered mutual fund distributor and certified wealth manager. Have you ever heard about the 50 is to 30 is to 20 equity rule? Then let's learn more on this strategy in this video. The 50 is to 30 is to 20 equity allocation strategy suggests dividing equities investment across different market capitalization segments. Let's get into the more details on this asset allocation strategy to know how efficiently it can create more wealth for us. Mid cap and small cap mutual funds have continued to attract investors, with June 2026 Amphi data showing strong inflows into these categories. However, investors should not chase recent returns and must follow a balanced equity allocation strategy. This 50 is to 30 is to 20 equity allocation rule implies nothing but 50% in large cap, 30% in mid cap, and 20% in small cap allocation, which can help investor balance growth opportunities along with the risk management. Mid cap and small cap funds have emerged as preferred investment choices amongst investors looking for higher long term returns. However, the investor should carefully assess their goals, risk appetite, and investment horizon before increasing exposure to these categories. Investor should follow a process driven approach instead of changing allocation based on the market trends. Your market capitalization allocation should not change because of recency bias. Maintain the allocation that you have decided. Around 50 to 55% should remain in large cap, 20 to 25% in mid caps, and the remaining allocation can go towards small caps. Let's have little more details on this strategy. As mentioned earlier, 50 is to 30 is to 20 equity allocation strategy suggests dividing equity investment across different market capitalization segments, which means 50% in large cap funds, which provides stability and helps reduce portfolio volatility, 30% in mid cap funds, which offers higher growth potential compared to large caps, 20% in small cap funds, which help investors participate in growth opportunities but comes with higher risk. According to the expert, this mix allows investor to participate in the growth potential of mid and small caps while remaining stability through large cap exposure. It's very important to make a note that the asset allocation should depend on an investor's age, risk profile, and financial goals, as the asset allocation changes with the age. If you are young and your goals are far away, you can take higher equity exposure, but as you approach your goals, your portfolio should gradually becomes more defensive with the less riskier portfolios. Also, here we need to think, why are investors increasing allocation towards mid cap and small cap funds? June 2026 Amphi data showed strong investor interest in mid cap and small cap mutual funds. That the mid cap fund received around rupees 6,100 crores inflows during the month, registering nearly 60% year on year growth, while the small cap funds saw inflows of around rupees 5,500 crore with a growth of nearly 40% year on year. Overall, this year has been quite positive for both mid cap and small cap categories. Around rupees 30,500 crore has come into these two categories. That is, around 33% of equity allocation has moved towards mid cap and small cap funds compared with around 20% last year. So we can say that the strong earning growth expectations are one of the key reasons behind rising investor interest in these categories. Mid cap earnings are showing around 80 to 20% growth potential, and similar numbers are visible in small cap for financial year 2027. When earnings growth remains in this range, positive sentiment develops amongst the investors. If we can see, why do mid cap and small cap funds attract investors? India's young investors base and long term investment approach are also supporting flows into these categories. As India's average age is around 31 years, many SIP investors are young and investing for long term goals. That is why they are taking allocation towards small and mid caps, as the smaller companies have greater growth potential compared to larger companies, which implies a company with a very large balance sheet may find it difficult to grow 15 to 20% quickly, but a smaller company can grow much faster because the base is smaller. And the expert believe valuation in these segments have become more comfortable. Small caps are trading at discount in present scenario, which is why investors are looking at this opportunity. So, expert advise new investor to avoid directly jumping into small cap funds without understanding the risks involved in it. It can be noted here that two factors are important before investing: risk appetite and investment horizon. If the money you are investing is not required for next 7 to 8 years, then you can consider small cap funds. However, investors who cannot tolerate sharp market falls should avoid aggressive small cap exposures. Small cap give better rewards, but they also see higher downwards compared to large caps, mid caps, and or flexi cap funds. For beginners, it is suggested to start with diversified equity options before moving towards aggressive categories, because if you do not know swimming and directly jump into 10 feet water, it is not the right approach. So, first time investor can start with flexi cap funds and gradually increase exposure to mid and small caps. Experts believe investors should not invest only because a category is performing well, and mutual fund investors should focus on generating long term alpha rather than chasing short term returns. Large cap alone may not generate significant alpha, as they closely track indices like Nifty 50 and Nifty 100. Mid cap and small cap exposure can provide opportunities for additional returns, which means existing investors should avoid increasing allocation only because these categories have recently performed well. Investors should not get influenced by recent performance. Markets follow cycles, and categories go through periods of underperformance and recovery. So, we can say that the long term investment horizon for mid cap funds needs to be minimum 7 years, and for small cap fund it needs to be 7 to 10 years or more. Investors should shift money to safer assets when they approach their financial goal. It means when you are close to your goal, move the money into safer assets. The purpose behind this advice is to protect the wealth that you have created. You can make a note on this key takeaway for investors, that the 50 is to 30 is to 20 equity allocation rule can help investor create a balanced portfolio by combining the stability of large caps with growth potential of mid and small caps. However, experts emphasize that the right allocation depends on the investor's age, financial goals, risk appetite, and investment horizon. First time investors should avoid directly chasing small cap returns and should build exposure gradually through disciplined approach. Please book your free consultation today using given link and stay tuned to my next piece of content for more enlightening insights into the different topics of investment world. Until then, take care. Bye.